Good morning. This is Connor from 500 Edge, where we trade SPX 0DTE options. If you want to join the team, link in the description. In this video, I'm going to recap the previous session and break down what matters today ahead of the opening bell. On Wednesday, we took a total of 2 trades, both winners, for a total absolute return of $4,779 or 2% in our 1% risk model portfolio, where we are risking no more than 1% per trade. Played both directions, 74.20 long calls and 74.25 long puts. Now, 2% may not seem like a lot, 2% here, 1% there, but it most certainly adds up. We're coming to the end of the month, and the portfolio is up 32% and 143% since inception, not even 3 months ago. And we trade an institutional grade framework, although it is relatively simple, trading level to level with mostly single options, long calls, long puts, and all the trades are sized consistently. Again, no more than 1% per trade. So when we do have losing trades, it is not devastating to the account or you emotionally. And don't get me wrong, we most certainly do have losses. It is part of trading, but we do a very good job at controlling that drawdown. The max drawdown since inception is 2.28%. If you want to learn our framework, how we approach SPX 0DTE trading, join the team, link in the description. We saw selling pressure right from the open, negative market internals, ADD, which measures market breadth, negative 500, which persisted throughout the full session, growth underperformance, a brief period of outperformance here. So growth did lead the market rally off 73.50 into 74.50, but peaked and came crashing down. Matter of fact, it was a sell everything event in that last hour. Interestingly, SPX broke the macro upsloping trend line prior to the rate decision at 2 o'clock. Now, we did have a number of negative geopolitical headlines, and there was uncertainty regarding rate expectations. So recall, there was only a 65% probability of no change, far from the consensus we're used to at 98 or 99% probability. But this is what you get when you remove forward guidance. Nonetheless, we did revert back to that macro trend line prior to the announcement at 2 o'clock. So you can see the big 2 o'clock candle right here. No change. So that was in line with the probable outcome. Once again, 65%. And we played those probabilities, actually positioning prior to the FOMC, which is usually something I don't do. But I bought calls here. Clearly didn't pick the bottom. We came down to that 50 handle. Nonetheless, we got the reaction candle we were looking for on the no change and moved into our long strike at 74.20, and we closed out into that move. A nice pullback here, retest of 73.85, that was 0 gamma previous session's low, for a nice move higher into the big 74.50 zone, which we're all familiar with. So if you zoom out, this has been the upper bound over the past, 4 or 5 sessions now. A big confluence zone. So gamma level, upper bound, previous session's high 74.52. We had that downsloping trend line, which is a little bit cleaner on the SPY, and the max call strike, which was 74.50, the strike with the highest 0DTE call volume. So a huge confluence zone here on the SPX. And if you look at the VIX, we were back down to 17.5, 17.3, a level we have played off of many times, looking for that vol bid. Additionally, that was the upsloping trend line originating from the low of 15. So we had major support on the VIX, major resistance on the SPX, and we shorted this level looking for a move back down, and that played out very well. On the 1 hour time frame, we have a massive topping wick above the macro upsloping trend line in yellow. Now, when I refer to a macro trend line, it is a trend line that connects the swing highs or lows across more than 1 month. And if we zoom out to the 4 hour chart, we can see that this trend line originates from the June lows. We tested it mid-June. That's what formed the trend line. And this has been support over the past 4 trading sessions. And when you have a trend line that is on the higher time frame like this, it is watched by more participants, day traders, swing traders, position traders, etc. So it becomes more meaningful. And given the fact that we closed below it at lows, and the fact that we had a range break here is most certainly a bearish indication. We are down at major support here, the SPX 7300 strike, a big negative gamma strike, and there's a lot going on. FOMC, of course, participants are going to have to digest this, reposition accordingly if needed. We have earnings, geopolitics, end of month flows. So who knows if we'll get continuation or not, or we get kind of a move back up into this range. But we do see a change in dynamics, and we would start to expect more volatility in both directions moving forward. For today in the pre-market, all major U.S. equity indices are in the green, ahead of PCE and GDP due out at 8:30. S&P 500 up 0.7%. Nasdaq outperforming up 1.3%. The VIX down 7%, back to the macro pivot of 19. The previous session's low shows at 73.14. A break below implies downside continuation, an outside day. However, just below is the SPX put wall at 7,300. That remains the largest negative gamma strike going into month-end option expiration. Below that, 72.80, 72.70, so a bit of a gamma cluster here, followed by 72.50 and 72.40, which is the 5% down level from the all-time high. And if we just zoom out here to the 4-hour chart, we can see 7,300 is also the low from mid-June, and then that 50-40 zone is the low from early June. So key technical levels here as well. For the VIX, levels unchanged, 20.5, a key level on the upside. This has contained price over several weeks. 19 remains the macro pivot. That upsloping trend line still in play. Potential support around 18. And then we got the 17.5, 17.3 handle, and then 16.5, which was also another breakout strike. Transitioning to our dashboard, total gamma exposure for the SPX is negative, 825 million notional. Trading below our main transitional level, 74.75. Below, all strikes are negative. That is destabilizing for the market price. Above, all strikes are positive. That is supportive for the market price. Now, when we're in negative gamma, we do anticipate elevated volatility as dealers chase deltas, selling weakness, buying strength. And we can see the relationship between volatility and GEX via the return distribution chart. So what we have here is the vertical line in the middle is the zero gamma level. That is 73.85. To the right, positive gamma. To the left, negative gamma, with each dot representing a day. So this is historical data. Now, the deeper that negative gamma, the wider the return distribution. So more volatility on the downside and more volatility on the upside. Now, in terms of volatility today, options are pricing in a 1.2% implied move. That is an implied high of 74.04 and an implied low of 72.28. 7,300 remains the put wall. That is the strike with the highest net negative gamma, the largest support level in the market, viewed as our downside target and lower bound. We nearly tested this in yesterday's session. Matter of fact, we actually tested it just shortly after the close. We saw a bit of follow through on the downside, but we are up off this level, which is a bullish indication. Bulls need to reclaim 73.50 and 7400 for some improvement in that gamma profile. So starting to move towards positive territory. On the downside, below 7300, gamma cluster 7280, 7270. 72.50 and 72.40, that 5% down level. Not significant in terms of gamma, but it will be watched by many participants. On the calendar today, PCE and GDP due out at 8:30, and Apple and Amazon earnings are reporting after market close. Key indications for directional skew today: megs, semis, Nasdaq fell more than 10% from its all-time high, so we could see some buying activity there. And then VIX as a trigger for those feedback loops, both positive and negative.